Today, we're going to talk about a trading strategy that you have probably seen everywhere, the 15-minute opening range breakout, or ORB. Now, it looks super simple on the surface, but for most people, it's a financial trap. So let's dig into why it fails, and more importantly, how you can actually fix it.
I mean, you can see the appeal, right? The idea of one simple, clean trade to kick off your morning. But let's be honest, if it were really that easy, why are so many traders losing money with this exact strategy? So to really get why this is such a trap, we first need to be crystal clear on how the basic strategy is supposed to work. Let's break down the mechanics. At its heart, it's all about momentum. The market opens, there's this big burst of activity, and the whole idea behind the ORB is to just, ride that first big push right out of the gate. The mechanics couldn't look simpler. You watch the first 15 minutes of trading, say from 9:30 to 9:45 a.m. Eastern. You draw a box around the high and the low of that period. If the price breaks above the box, you buy. If it breaks below, you sell. It sounds almost automatic, doesn't it?
And this is where the problem starts. The very thing that makes it so appealing, its simplicity and predictability, is exactly what makes it such a dangerous trap, especially if you're just following the rules without understanding the bigger picture.
And that's really the key insight here. That first obvious move that looks like a beautiful clean breakout, well, more often than not, it's a setup designed to fool the crowd. Okay, so think about it. This strategy is a victim of its own popularity. The big players, the institutional traders, the so-called smart money, they know that countless retail traders have their buy and sell orders waiting just outside that 15-minute range. So they can just nudge the price enough to trigger all those orders, grab all that liquidity, and then slam the price in the other direction, leaving everyone else holding a losing trade.
And you don't have to take my word for it. To put this to the test, the source actually back-tested the pure ORB strategy. They used it on gold, which is a super volatile asset, where this strategy is often recommended. And if you look at 8 recent trading days, well, the results speak for themselves. 5 losses and only 2 wins. Ouch.
And here's the bottom line. After 8 full trading days, following the simple rules with a pretty standard risk-reward ratio, you'd be down 0.5%. Think about that. That's over a week of trading just to lose money.
And this happens because the basic strategy has absolutely no context. It doesn't care about the overall trend, it completely ignores market structure, and it has no idea where the real pools of liquidity are. You're just reacting to one candle breaking out of a box. And that's not a strategy, right? That's just a gamble.
And this just perfectly illustrates the huge disconnect. The idea is you're going to get one clean, simple breakout. But the market reality is that these ranges create liquidity pools. They're like magnets for price. And fakeouts are specifically designed to trigger those breakouts and then lead to a sharp reversal. So does all this mean the ORB strategy is totally useless? Should you just throw it in the trash? Not at all. It just needs to be smarter. The real key here is adding context, and our source gives us a great 3-step process to do exactly that. So instead of trading blind, you start adding layers to your analysis. You align yourself with the bigger picture. You learn to spot the trap instead of falling for it. And you wait for multiple signals to all line up before you even think about putting on a trade. First things first, you zoom out. Before you even look at the 15-minute range, you check the 1-hour chart to figure out the market's overall bias. Is the trend up or is it down? By doing this, you're only taking trades that are flowing with the market's current, not trying to swim against it. All right, step 2 is where it gets really clever. You can completely flip the script. Instead of trying to catch the breakout, you anticipate the fake out. You actually wait for the price to break the range and then fail, coming right back into the box. That re-entry, that failure, that becomes your new trade signal. You're basically turning the trap into your opportunity. And finally, you never rely on just one signal. You've got to add other tools to your arsenal. Does the breakout also break a key trend line? Is the price reacting to an important Fibonacci retracement level? These extra points of confirmation, what traders call confluences, are what separate a random guess from a high probability trade.
So this brings us to the most important takeaway from this whole analysis. And honestly, it goes far beyond just one single strategy. And that's the ultimate point. So many traders are out there looking for a simple shortcut, right? An easy system, a cheat code that's just going to print money without any real effort.
But in trading, those things just don't exist. The market is way too complex and way too competitive for that.
The real solution, the real cheat code, if there ever was one, is education. It's about taking the time to build a deeper understanding of how the market actually works. Concepts like market structure, how liquidity drives price, and the real dynamics of supply and demand.
So, I'll just leave you with this question. Are you looking for a shortcut, a simple strategy you can just copy and paste, or are you willing to actually learn the language of the market? Because that choice, right there, will ultimately determine your success as a trader.